What if the biggest financial threat facing America today isn't a recession? What if the headlines about inflation, interest rates, stock market volatility, and slowing growth are distracting people from a much larger development that is quietly unfolding beneath the surface? Throughout history, the greatest economic disruptions did not happen because of a single event. They happened because multiple forces built pressure simultaneously until the existing system could no longer function the way it once did. The people living through those periods rarely recognized what was happening in real time. Most believed they were experiencing temporary problems. Only later did they realize they were witnessing the end of one era and the beginning of another. Today, I believe we may be approaching a similar moment. The signs are not appearing in one place. They are appearing everywhere: in debt markets, government finances, geopolitical conflicts, technological disruption, wealth inequality, and the growing gap between economic reality and public perception. Individually, each issue seems manageable. Together, they tell a very different story. And if these trends continue, what comes next could be much bigger than a recession. Most people think about the economy in terms of short-term events. They focus on quarterly earnings, unemployment reports, election cycles, and market movements. But economies are driven by larger forces that operate over decades. These long-term cycles are often invisible because they move slowly. They are like tides rather than waves. You don't notice them changing from one day to the next, but over time they can completely reshape the landscape. One of the most important long-term cycles is the debt cycle. Every major economy in history has experienced it. The process usually begins with optimism. Credit expands, borrowing increases, investment grows, asset prices rise, wealth is created, confidence strengthens. The system appears healthy and productive, but eventually debt begins growing faster than the income required to support it. That's when vulnerabilities start accumulating beneath the surface. For many years, the United States benefited from a unique position in the global economy. The dollar became the world's primary reserve currency. Global investors viewed American assets as safe and reliable. This allowed the government to borrow enormous amounts of money at relatively low costs. Businesses could access cheap capital. Consumers could finance homes, cars, and education. The entire system became dependent on easy access to credit. As long as interest rates remained low and confidence remained high, this arrangement appeared sustainable. But history teaches us that every debt cycle eventually reaches a stage where borrowing creates more problems than solutions. Today, government debt is measured in tens of trillions of dollars. More importantly, interest payments on that debt continue growing. Think about what that means. Every dollar spent servicing debt is a dollar that cannot be used elsewhere. It cannot be invested in infrastructure. It cannot improve education. It cannot strengthen economic productivity. Over time, debt begins competing with growth itself. This is one of the reasons why debt problems are so dangerous. They don't usually create immediate collapse. Instead, they gradually weaken a nation's financial flexibility until difficult choices become unavoidable. At the same time, many Americans are experiencing a reality that feels very different from the one described by economic statistics. Official numbers may suggest growth, but millions of households feel increasingly pressured. Housing costs remain elevated. Insurance premiums continue rising. Healthcare expenses consume larger portions of family budgets. Grocery bills remain significantly higher than they were only a few years ago. Even people with stable jobs often feel like they are running faster just to stay in the same place. This disconnect between economic data and personal experience is extremely important because confidence plays a central role in every economy. When people believe the future will be better, they invest, spend, and take risks. When they lose that belief, behavior changes. One of the most powerful forces shaping the future is the widening gap between asset owners, and wage earners. Over the past several decades, those who owned stocks, real estate, and businesses generally benefited from rising asset prices. Meanwhile, wage growth often failed to keep pace with the increasing cost of living. This created a situation where wealth accumulated faster for those who already possessed assets. As a result, inequality increased. Throughout history, large wealth gaps have often contributed to social and political instability. This doesn't happen overnight. It develops slowly. People become frustrated when they feel that opportunity is becoming less accessible. They begin questioning whether the system is working fairly. Eventually, those frustrations influence politics, policy, and economic behavior. Another major transition is unfolding in technology. Artificial intelligence is advancing at a pace that few people anticipated. Every technological revolution creates both opportunities and disruptions. The Industrial Revolution transformed agriculture and manufacturing. The Internet transformed communication and commerce. Artificial intelligence may transform knowledge work itself. For businesses, this could mean extraordinary productivity gains. Tasks that once required hours may eventually require minutes. Entire processes may become automated. Costs may decline. Efficiency may increase. But there is another side to this story. Workers who spent years developing specialized skills may find themselves competing against systems capable of performing similar tasks at lower costs and greater speed. Historically, societies adapted to technological revolutions because new industries emerged to replace old ones. The challenge today is the speed of change. When disruption occurs faster than adaptation, uncertainty increases. Workers become cautious. Companies delay hiring. Consumers reduce spending. Economic anxiety spreads beyond those directly affected. This matters because economies are ultimately built on confidence. Confidence influences investment decisions, hiring decisions, and consumer behavior. Once confidence begins eroding, the effects can spread rapidly throughout the system. At the same time, the global environment is becoming increasingly complex. For decades, globalization helped reduce costs and improve efficiency. Countries specialized in different areas of production. Supply chains expanded across continents. Businesses optimized operations on a global scale. But geopolitical tensions are changing that environment. Nations are becoming more focused on economic security, technological independence, and strategic competition. Trade relationships are becoming more complicated. Supply chains are being restructured. Governments are prioritizing resilience over efficiency. While these changes may reduce certain risks, they can also increase costs and create new challenges for growth. History shows that periods of significant geopolitical competition often coincide with economic transitions. Rising powers challenge established powers. Competition increases. Governments allocate more resources toward security and strategic priorities. Economic decisions become influenced by political considerations. The result is a world that becomes less predictable and more fragmented. Investors and businesses must operate in an environment where assumptions that worked for decades may no longer apply. What makes the current situation particularly unusual is that these trends are occurring simultaneously. Debt burdens are rising. Technological disruption is accelerating. Geopolitical tensions are increasing. Wealth inequality remains elevated. Political polarization continues growing. Each of these developments would be significant on its own. Together, they create a level of complexity that increases uncertainty across the entire system. When multiple pressures build at the same time, the probability of larger structural changes increases. This is why focusing exclusively on whether a recession is coming may be missing the bigger picture. Recessions are normal. They are part of economic life. Economies slow down, recover, and continue growing. What concerns me more is the possibility that we are entering a period where the underlying structure of the economy begins changing. Structural changes affect everything. They influence which industries thrive, which skills are valuable, which investments succeed, and how wealth is created. They redefine the rules of the game itself. If there is one lesson that history teaches over and over again, it is that economic systems don't fail because people see the risks. They fail because most people assume the good times will continue longer than they actually can. Human nature tends to extrapolate the recent past into the future. When markets rise, people expect them to keep rising. When credit is easy, people assume it will remain easy. When governments continue borrowing without visible consequences, people begin believing there are no limits. But history operates differently. Every cycle eventually reaches a turning point, and those turning points often arrive when confidence is at its highest. One of the most misunderstood concepts in economics is the relationship between debt and money. Many people think debt is simply an obligation that must be repaid. In reality, debt is also a claim on future income. When debt grows faster than income for long periods of time, future growth becomes increasingly dependent on creating even more debt. This works until lenders begin demanding higher returns for taking greater risks. Once that happens, the cost of borrowing rises, and the entire system starts feeling pressure. Governments face larger interest expenses, businesses reduce investments, consumers cut spending, growth slows. The very mechanism that once accelerated prosperity begins working in reverse. This is why debt cycles are so powerful. They don't just affect financial markets, they affect nearly every part of society. When governments spend more on debt service, fewer resources remain for other priorities. When businesses face higher financing costs, expansion becomes more difficult. When households struggle with rising expenses, consumption weakens. Since consumer spending drives a large portion of economic activity, even small changes in behavior can create significant ripple effects throughout the economy. At the same time, many people are underestimating the psychological impact of economic uncertainty. Markets are driven not only by numbers, but also by expectations. When people feel optimistic, they invest aggressively, start businesses, buy homes, and make long-term plans. When they become uncertain, they postpone decisions. They save more and spend less. They become defensive. This shift in behavior can create self-reinforcing cycles. Fear leads to caution. Caution slows growth. Slower growth increases fear, and the cycle continues. What makes today's environment especially challenging is that many traditional solutions appear less effective than they once were. In previous downturns, central banks often lowered interest rates to stimulate borrowing and economic activity. Governments increased spending to support demand. These policies helped stabilize the system. But when debt levels are already extremely high, policymakers have less flexibility. Every solution creates trade-offs. Lower rates can encourage borrowing but may increase inflationary pressures. Higher spending can support growth but may worsen fiscal imbalances. The choices become increasingly difficult. Meanwhile, technological change continues accelerating. Artificial intelligence may become one of the most transformative technologies in modern history. Some people see only opportunity, others see only risk. The reality is that both perspectives contain elements of truth. AI will likely create enormous wealth. It may increase productivity, improve efficiency, and unlock innovations that are difficult to imagine today. But the transition could also be disruptive. Entire professions may evolve rapidly. Business models may change. Competitive advantages that took decades to build could disappear surprisingly quickly. When you combine debt challenges, technological disruption, demographic shifts, and geopolitical competition, a larger picture begins to emerge. None of these factors alone guarantees a crisis, but together they create an environment where significant structural change becomes more likely. This is what many people miss when they focus exclusively on short-term indicators. They look at monthly employment reports or quarterly earnings and assume those numbers tell the entire story. In reality, deeper forces are shaping the future beneath the surface. The people who navigate these periods successfully are not necessarily the smartest or the luckiest. They are usually the most adaptable. They recognize that conditions are changing before the majority does. They focus on understanding the larger forces driving events rather than reacting to daily headlines. They study history because history provides a framework for understanding how systems evolve, and most importantly, they understand that every major challenge creates opportunities for those who are prepared. The question is not whether change is coming. Change is always coming. The question is whether we recognize the scale of the changes already underway, because if these trends continue on their current path, the next decade may not simply be defined by a recession. It may be defined by one of the most significant economic transitions of our lifetime. And understanding that possibility today could make all the difference tomorrow.